Okay, so that is what happens with our bad debts. So it's very good for you to know that any company that is dealing with customers, it's much prudent for you to go ahead to make a provision. And this provision, of course, these provisions are really subjective based on what you expect. But where you have specific provisions, like the way we saw at the start, where you have, for example, John, who is not being traced right now, and you have to make a provision for them, like the way we saw here. Like the way we saw here. Okay. So we have a case here where John was not traced. So we debited our profit and loss account with 50,000 and then credited our John's account, debtor's account, because John is no longer traceable. John disappeared. So that is what we did. We have to write off this, and this goes to the P&L, and this goes to reduce. Then we've now seen the increase in provision for bad and doubtful debts, and we are saying for this, what we basically do is we debit our bad debts expense with the increment, only the increment, and then we credit our provision for bad and doubtful debts. And we say that this might happen maybe where the risk of more people not paying has increased, maybe because of change in the economy. So we have an example here where we went ahead to debit our bad debt expense with the 1 million, which was only the difference in this case, and then we created our provision for bad debts with the same thing. So just as we have the increase, we also have cases where we can have a reduction, maybe where we think that there is now more positivity in terms of debtors responding to their debt. And we are saying that for this case, here we debit our provision for, of course, we debit our provision for bad debts to reduce on the bad debts. Remember, we said provision for bad debts has a normal credit balance. So if you, anytime you see a debit of provision for bad debts, you're basically reducing your provisions. And that is why when it came to increase, we credited the account, because it has a normal credit balance. So every time it increases, we credit it. So that's what we did. And we said that this should be taken to our P&L as an income added to our gross profit. Now, there are also cases when it comes to bad and doubtful debts where, like for example, the example we've seen of John, John who was not traceable, where we can now access John. Maybe John returned back from Dubai. We hadn't known that he had gone to Dubai. Or maybe we had thought that John had died, but we actually able to collect. I think you remember those that follow news very well. There was a newly elected MP, I think in the areas of Valua, I think, if I'm to remember. That gentleman had a huge loan with Centenary Bank, and he disappeared mysteriously. They actually even did the burial. They even buried. Like they I don't know what exactly did. I think they also did the funeral kind of thing and so on. And this guy later appears and stands for MP and goes through. So at this point in time, I think Centenary was tipped off, and they went ahead to sue the gentleman because they had written off this guy because they thought the guy had actually passed on. So they had written off the debt. So in that case, they had to reinstate the debt. So we have another example here where they're telling us that on 1st July 2016, Mary sold goods to Joseph for 10 million on credit. Mary sold goods to Joseph for 10 million on credit. After 2 years, Joseph disappeared without trace, and Mary decided to write off the amount as a bad debt. Surprisingly, in 2018, Joseph surfaced, apologized to Mary, and paid her whole amount of money. Required, show the accounting entries for the above transaction. required, show the accounting entries for the above transaction. So these cases are very common. So we wrote off this 10 million. So the first thing is to reinstate Joseph as a debtor in our books. Remember, Joseph is no longer in our books because we wrote them off. So what we are saying is that we have to go ahead to reinstate them as a debtor in our books. And we do that by debiting our accounts receivable. We shall go ahead to debit our accounts receivable, which is Joseph's account. This is reinstating with the 10 million. And we shall credit our bad debts recovered account with 10 million. We shall credit our bad debts recovered account with 10 million. Now, after we've gone ahead to reinstate Joseph in our books, we now go ahead to recognize his money against the reinstated receivables by debiting our bank with 10 million. We shall debit our bank with 10 million. Remember, Joseph is paying us. The question is telling us that Joseph first apologized and paid her all her money in full. Now, we're also going to see cases where this person does not pay us money in full. You get it? Eh? Maybe the value was 10 million, and now he comes after some time and says, I can pay you only 8 million. So in that case, we also, of course, we reinstate only the value that we are going to receive. So we are debiting our bank with the 10 million, which we are receiving, and crediting our accounts receivable with the 10 million. Remember, we have already reinstated it. So this account exactly, it exists. So then we have the third step, which is to close the bad debts recovered account to the P&L. We close off the bad debts recovered account to the P&L. And here they are telling us is we debit our bad debts recovered account with 10 million. The reason why we are doing that is because at reinstating, we credited our bad debts recovered with 10 million. So at a point in time when we are, of course, closing off this account, we have to debit it. So that this 10 million that is on the debit side counter cancels with the one that is on the credit side at a point of time of reinstatement. And then the other is we credit our P&L in terms of other incomes and give it 10 million. So that is what we basically do. Because the reason why we are bringing income here is we had written off this guy and we had recognized this as an expense, as a bad debt expense. Now, the reason why we are reinstating it as back as accounts receivable is, of course, recognize to make sure that we have something to recognize the money against. But also, after we have done that, we are also saying that we go ahead to actually credit our P&L with the 10 million as an income, because this money had been written off already and now it has come in within our books. Okay, so before that, I want us to look at something. I hope that is clear. In case you have any question, please use the chat box so we can see how to help. But I want us to look at one question that has provision, so we can try to think together and be able to put up this. Okay, so this paper is, you can just note it down. This is August 2019. August 2019. You want to move down. Now, provisions are usually examined in this question of where they bring you a trial balance and they ask you to prepare the financial statement. So they usually bring it as an additional information, like any other transaction. So I had to just interest ourselves on the area of provisions, so we can see what to basically do. So I see something here. There's something here. So they are telling us that management decided rate of 2.3 million relating to a debtor who was facing serious financial difficulties. Management decided write off a debt of 2.3 of the debtor who was facing financial difficulties. Let me see if there is anything to do with provisions. Okay, you can just even look through. I think you see in our books, we already even have bad debts. We already have a bad debts of 10,500. We have our trade receivables and trade payables. So this is trade receivables. Let's see if we have a provision here. Okay, we don't have a provision. So back to our question, for us to understand this much better, remember, we had a case for write-off example here, where Jen was running a stationery shop and realized that to date John hadn't paid and disappeared with trace. You see what we did? We debited our P&L bad debts with 50,000 and credited our debtors account with 50,000. So it's the same thing that we also do for this case. We shall also go ahead. Remember, we even have bad debts account there. We shall go ahead to since we are writing off, we shall go ahead to debit our bad debts, our P&L in bracket bad debts with a 2.3, and we shall credit our trade receivables. Trade receivables are also debtors. So we shall go ahead to credit our trade receivables with 2.3. Now, this would have been different in case this thing was, this kind of scenario was a doubtful debt, maybe where we are making just a provision. In this case, we are writing off. Now, writing off is different from making a provision. You get it, huh? In this case, since this person is facing financial difficulties, we are basically writing off the amount. So every time you see the word write-off, you go directly to the account, the trade receivables account, and credit. Remember, trade receivables are current assets, are assets that have a normal debit balance. So we credit them to reduce with a 2.3. So that would make what we have here. Remember, trade receivables, we have 42,500,000, I think 500,000. So by the 2.3, it will reduce it by that. So in this case, we shall not make a provision, but rather write off the amount, like the way we have the example there. So I hope we are able to understand how that plays. So that is how provisions can be. They usually bring like a single line. Yeah, but of course the examiner can also wake up and maybe bring you several items, and you have to be able to present and give clarity on exactly what should be able to be done. Okay. Yeah. Let's see if we have a case of Anyone asking a question? Is everything clear?
Yeah.
Okay, that is good. That is good. Okay. So I was trying to look for another question here. So you can note also this. This is November 2019. Like I indicated earlier on, these papers can be accessed on the ISPA website in case you're already registered. In case you're not registered yet, you can be able to I think since they have opened up, I would encourage everyone to register as a student in case you're just a new person. But you can get this from a colleague who is registered. Anyone who has been ISPA still has an account. Myself, I think I was a student of ISPA several years ago, but I still have an account and I can access these papers. So anyone can be able to get you these papers. So we have a question. I think it's a question, last question here. So this question, they're asking us a purpose of preparing a trial balance. Remember, we now know what a trial balance means. A list of balances from the ledgers. So the purpose, of course, we use the trial balance to prepare the financial statements. You get it? But also the trial balance can also help us detect if we have any errors at hand. Okay, sorry about that. Can we see the screen very well? Okay. So the accounting clerk of Zibla today, Zal, has provided the following trial balance for the year ended 31st December 2018. So we have rent, utilities, salaries, stationery, sales revenue, returns, purchases, inventory, and so on, land, etc. We also have additional information here. Okay, this is still our trial balance ending right there. So we have different additional information. We have, okay. Now this is where I want to put our focus today. Okay. So they are telling us that James, a debtor with a balance 2450,000 disappeared, and his balance should be written off. The allowance for bad and doubtful debts as at year end is estimated at 5% of the remaining receivables. Now, this would give us a very good example. Now, we go back to our trial balance and see anything about around doubtful debts. So we have bad debts here, which is 27,500. We also have allowance for bad debts. We have the allowance for bad debts, which is 3,450. Now, this word allowance, sometimes instead of calling provision, they can call it allowance. The same thing also for depreciation, can also be called allowance for depreciation. So don't be confused when you see that. So we have this 3,450. And then the other value that we're also interested in is the trade receivables. Those are the accounts that are affected by the bad debts. So they are telling us that part of this 45,400, 45 to 400, there's a client, a debtor of this value who disappeared, and his balance should be written off. So what we shall basically do, remember our write-off, we've already understood what we do with the write-off. So what we shall basically do, this is our question. We are saying that we shall debit our, you can say debit profit and loss, the profit and loss, or you can say debit bad debts account. And then we shall credit. We shall go ahead to credit our. Now, since it's a write-off, we shall go ahead to credit our trade receivables. If it just was a provision, then we shall bring in provision. And the value we have, it is 20450. Okay, so that is what we have. Now, once we have that, they are also telling us something also. They are telling us that the allowance for bad and doubtful debts as at year end is estimated at 5% of the remaining receivables. Now, yours is to first look and see how many receivables do I have? Sorry, these are receivables. 45,400. So of the 45,400 already, we are writing off this value. And then what remains, they are saying an allowance of 5% has to be made. So what we are going to do, we are going to, since we, what we can basically do, we can even put it, we can do a ledger. Okay, not do a ledger, but we can say as trial balance. So what do we have as per the trial balance for trade receivables? It's 45,400. These ones are thousands. 45,400 thousand. I think it's like that. 45,400,000. So we have to calculate the new value of receivables after the write-off. Remember, we are crediting. So I shall say let's write off. You can also do this within a T account. This is write off. So we have 2,450. So it gives us our remaining receivables to be the summation of that. So that is what I have. And then what I remain with, so I'm now going to make a provision. Remember, they are telling us that the new provision will be at 5%. So it will be at 5%. So I'm going to do 5% of this value. So I'm going to do 5% times 42,950,000. 42,950,000 to give me 2,147,500. So this is a provision for bad debts. I'll call it new provision for that debts. Or since in this case they are calling it allowance, I will say new allowance for bad debts. It's the same thing. Now, good for us to note that when you look back again, Our current allowance for bad and doubtful debts stands at 3,450. So this we need to write it. So say current or old allowance for bad debts is 3,450. I'll add my 3 zeros to be at that value. Now, every time you have a new allowance for bad debts, just like the question was saying here, just like the way we had in the additional information here, where they're saying that at the end of the year, it's estimated to be at 5%. Yours is first calculate the 5% of the remaining. After removing what you're writing off, in case you have anything that you're writing off, you first remove it. In case we didn't have any, we just get this 5% and subject it onto our trade receivables. But since we have something we're writing off, we're getting this 45,400, remove what we're writing off and remain with the balance. Now, after we have remained with the balance, ours is to go back and calculate what is 5% of the balance, which we have gotten. Now, after we have gotten that, we have to compare it with our current or our beginning allowance for bad and doubtful debts before the company did a review. Now, this is where the element of increase and decrease comes in. This is where the element of increase and decrease comes in. Now, when you compare what we have here, you can see that there is actually a reduction. There is a reduction. There is a reduction in provision. There is a reduction in provision. And the reduction in provision is 3 less the 2. So the reduction is actually 1,300,500. Now, this reduction, remember what they told us about the reduction? They told us that when we have a reduction, the double entry for us is to debit our provision, or you can call it allowance for bad debts, with the value, which is 1,302,500, and we shall credit our profit and loss account with the same value. Profit and loss with the same value. Just to take you back here, I think you can see we had the reduction here. They're saying if accounts receivables start paying and there's little doubt that bad debts will be collected, the provision for bad debts, which was once high, can be reduced. The entries here are opposite of the provision for increase. We debit our provision for bad debts and credit our P&L. So that is what we have done for this transaction. That is how we have done it for that transaction. We also have cases, of course, where they will just give you a value. So you don't have to calculate the based on percentage, they will give you a new value. So you just compare directly. But in this case, they have given us, we have to first calculate our new allowance for bad debts and then compare. The principle here is first remove what you're writing off, because you cannot make a provision for what you've written off. You get it? Written off, it's basically you've credited your receivables, so they are no longer part of your receivables. So that is why we only make a provision on the remaining. You get it, huh? So it's good for you to master how each of these provisions work. because at the end of the day, you want to make sure that you are getting all the respective marks on any question. So we have cases where we can get a recovery. That one I think maybe I'll get a question and maybe share that with you for you to know how that might be. But I want you to try out this. Just note it down. This is in December 2020. Just try out this additional information. December 2020. We have okay, we have a question. Is it question 3? It's question 4. This is what they're asking us. 2 fundamental qualitative statistics that make information provided in financial statements useful. 2 marks. This one you should be able to earn the 2 marks. You know the fundamental qualitative statistics. Okay. So our trial balance is here. We have a case here. So they are saying management of FFCL passed a resolution to write off 6.5 million in debts and to adjust the provision for bad debts to 5% of the final trade receivables after all related adjustments have been made. Okay. So this is the same thing that we've just done. Get your receivables. We have debtors here. Get 6.5 off it. Make the new provision 5% of that value, and go and look for your current provision. Provision for bad debts is at 5,600. Compare the two. Determine either it will be an income or an expense, and then you play with that accordingly. Yeah, make sure you try out so you can master these things. These things are very easy. You shouldn't be afraid. So is that okay? I hope it's okay. So that is how simple provisions can be. So you can look out for more questions, especially like I said, mostly questions that mostly questions that have questions to do with preparation of financial statements. This is I think the last exam for this year, the March 2021 paper. They also had something small down here where they were saying that the bad and doubtful debts are treated as operating expenses. Bad debts of 10 million were written off and a provision for doubtful debts of 5% per annum was made. Now, this should really open your eyes that the examiner is not going to look for questions from another place. These examiners just get something and keep on just changing the name, twisting a little. So if you can be able to do several kind of questions, then you shouldn't be able to miss really understanding each of this kind of information. Yeah. So that is how our bad and doubtful debts work. Okay. So then we have the other is corporation tax, is corporational tax. Now, what happens with corporation tax? Of course, I told you that in most cases, because of the legislation, we usually fail our taxes after the end of the tax period. You get it? And we know very well that tax is subjected on our profits. So when a company earns profit, we have to make a provision for corporation tax that will be paid to the tax authorities in the next financial period. You get it? So we make a provision at the end of the year after we've determined that we have a profit. And what they're telling us here is the accounting entries. We debit our P&L corporation tax. Remember, corporation tax is like an expense. So that's why we debit it to reduce our profits. And then we credit our corporation tax payable. So when you look at our P&L, you'll be able to trace corporation tax. And then when you look at our statement of financial position, you should be able to see a corporation tax payable as an obligation that is to be paid to URA or to any tax authority in case you're in another country. So when we get to the point in time when we make the payment, when the tax is finally paid, we go ahead to debit our corporation tax payable. Of course, this is a liability that is now reducing. And now we shall go ahead to credit our bank and cash, depending on how we are paying this. So that is very simple. Providing debit your P&L because it's reducing your profits. It's more like an expense would be, and credit your corporation tax payable. So that when you present your financial statements, somebody is able to tell that, okay, even with this amount of profit, this is an amount that is yet to be paid to the tax. Like I said, at that point in time, you've not paid because of the leeway that the tax authorities give you to pay after a certain period of time, like after 6 months. So that shouldn't be able to worry you. And then when we pay, you've seen debit corporation tax payable and credit your cash and bank to recognize that transaction. Then the other that is a bit similar is, of course, the audit fees. Now, also, this could be common. Okay, if any organization really does an audit, but it's very common with the listed organizations. So we should also provide for audit fees. Reason why we make a provision for audit fees is also these auditors, remember, are going to audit our financials, and at the end of the year, they have not yet completed, of course, the audit. So we have to go ahead to make a provision by debiting our P&L and include the audit fees, and then we shall credit our audit fees payable. And when the audit fees are paid in the next period, we shall debit our audit fees payable, because in this case now, the liability is decreasing, or we have to write off the liability, and then we are crediting our cash and bank with the same value. Yeah, like that. So the provision for audit fees from the company, of course, the audit fees will be deducted from the company as an operating expense. The provision for audit fees is deducted from the company as operating expense. Like I told you, it's an expense, definitely, but you've not paid it. So we are bringing the accrual concept here. Even if we have not paid, we are going ahead to make an accrual for that transaction. Okay. All right. So we want now to see how we can present our financial statements, given the fact that we have understood the end of year adjustments. We've also understood how to prepare trial balance. So it's very imperative for us to now look at how to prepare the financial statements. So any complete set of financial statements should have a statement of financial position, which others call the balance sheet. Should also have the statement of P&L and other comprehensive income. Should also have a statement of changes in equity, a statement of cash flows, and a notes to accounts. Okay. They're just trying to give us a picture here that companies, some of you might have seen financial reports for companies, where they go ahead to add maybe a chairman's review, like audit reports. Chairman's review, they add CEO's review, they put the summary of the financial information, then they put the dividend policy, reports on health and safety and environment, and so on. Okay. But these are basically additional reports that really matter to the organization. This is very common with the listed companies. When you look at their financial reports, you will not only see the P&L, the statement of change in equity, the financial information, but there is always at least information from the other party. You get it? Okay. I'll show you an example here. Okay. We shall see something small as we proceed. Okay. So we have their general assumptions in preparing the financial statements according to IS1. Now, IS1 is International Accounting Standards 1. It's the one that gives us guidelines on how to prepare our financial statements. So the first one is the going concern. Remember what we said about going concern? With going concern, it's an assumption that the company will continue to operate in the next 12 months, beyond the next 12 months. You get it? So going concern is a principle here, assumption. The accrual basis of accounting, we recognize transactions as they occur and not necessarily when cash transfers hands. For example, revenue is recognized when earned and not necessarily when money is received from the customers. The same thing with expenses. Recognition for expenses is recognized at a point when we incur them. Even when we have not made the payment, we should go ahead to incur them. Just like the way we've seen audit fees. We make an accrual for them before we even pay them. Then materiality and aggregation. Anything is material if at all its omission or inclusion would affect any economic decisions that are made on any financial kind of information. So I'll give you an example. What by materiality brings in here is that anything that is material should really be included in the financial statements. And not only materiality, but we have also an aspect of aggregation. Now, aggregation, I'll give you an example. A purchase or maybe a sale to a customer, one of your lower customers, maybe you, if for example, I'm a customer to Airtel, and let's say I have an outstanding beta loan of, let's say, 5,000. Now, when you look at the financial statements of Airtel, the 5,000 is really very small. The 5,000 is really very small. But when that 5,000 is aggregated in terms of if we have different customers who have balances of, let's say, 5,000, and these are 1 million customer. When you multiply 1 million customer times 5,000, that will already get you to 5 billion. So that is where the aggregation comes in, and that is how it relates to it. It is a bit similar to aspect of materiality. So as you regard something to be immaterial, think about its aggregation. If at all different items that are immaterial are aggregated together, what then happens? You get it? Yeah. Then we have the offsetting. Offsetting happens cases where a company may be both your customer and may also be your supplier. For example, if maybe maybe I'm dealing into maybe repairs and maintenance of vehicles. I'm a garage, I have a garage. So MTN can be my customer. Maybe it brings vehicles for its staff and I repair them. And they can also be my supplier, where they provide me with internet data. Now, offsetting comes in where receivables can be offset for trade payables. For example, if I have an outstanding amount to pay for my data to MTN, we may agree to offset it by the invoice that I'll be giving them for repairs and maintenance. So just a principle like that. And then frequency of reporting. Of course, frequency of reporting, you may be reporting biannually, you may be reporting annually, reporting monthly or quarterly, and so on. Then comparative information. This is about compare. Information should be able to, you should be able to compare yourself against previous periods, maybe your financial statements. If you have financial statements of 2019, they should be able to, we should be able to, the way they are drawn, they should be in a position where we can compare our performance of 2019, maybe with that of 2020. You get it? So the comparison and the comparative information should really be very clear here. Comparativeness can also be looking at the aspect of comparing with another company in the same industry. You get it? So our financial statements should be in a way that we can be able to compare those financial statements with another company that is within the same industry. You get it? So that is how that can come in. And then consistency, of course, consistency in presentation. Yeah, this is also also to enable the comparison also to take place. Basically, if you're preparing your financial statements, they should be in a way that you have some element of consistency. Something that you did last year should make sure that it's something that you continuous doing. For example, if you're doing straight line depreciation, unless for other queries decisions that are around the changes on your accounting policies, we expect that you have some element of consistency. You get it? And also one of the things why consistency is very key is it helps us to compare different financial statements over a period. Some of the things that repeat offsetting. Now, offsetting might happen in cases where a business a business has another company that is both a customer and is also could be also a supplier. So where you have cases where maybe if I'm a garage, I own a garage, my customer is, let's say, maybe Airtel. Airtel provides me with data, services, and for me, maybe I offer repairs and maintenance of their vehicle. You get it? Huh? So what we are saying here, that offsetting might come to cases where we have to write off to basically, if I have an outstanding balance with, let's say, Airtel for data, and maybe I also have maybe an invoice that I'm yet to give to them for repairs and maintenance. So we have cases where we can go ahead to offset the debtors with the accounts payable. You get it? Huh? So that can happen in case, of course, they are similar amounts. Okay. So I hope that is clear, Michael. All right. Okay. So these ones can just try to go through them. Okay. So IS1 requires that financial statements, of course, should be clear. We should be able to clearly identified and distinguished from other information published in the same document. So the following information must also be prominently displayed. So the name of the entity, very clear, and this is why headings are very clear. Whether the financial reports relate to a single entity or group of entity also has to be clear. Here cases where we have multinationals or group of companies. So that has also to be clear. The reporting period, are you looking at financial year 2019-2020 or it is 2020-2021? Okay. The presentation currency, okay. Very important. Any rounding used, in case maybe you round off to the nearest 10th, it's very good for people to basically know that. So we want to start with the statement of financial position, which is our balance sheet. Remember, we said our balance sheet looks at our assets, looks at our liabilities, and looks at our equity. You get it, huh? So it basically details us. The word statement of financial position, basically you're trying to find out what is my stand at the end of the financial year. And that is why when we are rating the heading of statement of financial position, we say as at. So at that point in time, how much do you have in assets? How much do you have in liabilities? You get it? How much do you have in, say, maybe equity as well? So it's very important. So what the entity owns are assets. Any external claims, those are liabilities. You also should be able to remember our definitions as per the conceptual framework. Then in the internal claims, that is of course equity. Now we also have, I think we remember our recognition criteria for assets, liabilities, and equity. Now to record, anything should have a monetary value. Basically, the value should be reliably measured. It should satisfy the definition criteria of asset, liability, or equity, and should also satisfy the recognition criteria. We provided recognition criteria when we are looking at the conceptual framework, so I want you to reference back to that. So we have an example here. To recognize an asset, the following criteria must be fulfilled. It is probable. By probability, we are looking at 50% chances greater that future economic benefits will flow to the entity from this asset. And we also have control over this asset. And then the value of the asset should be basically measured reliably. Okay, so we have an example here of how our financial statement of financial position might look at. As you can see, okay, here we put 2 years, 2017 and 2018, and then 2016 and 2017. But basically, these are our current assets. So like you see, we have our top headings, we have assets, we have liabilities, and then we have equity. So assets are usually broken down in terms of current assets and non-current assets. The word non-current assets, they can also call it fixed assets. It's the same thing. Current assets are these assets that of course are going to last for a period that is not more than 12 months. So they will be consumed within a period of 12 months. Things like inventory, stock, inventory can also be called stock. Things like accounts receivable, which are our debtors, the people that we sold to on credit. So we expect them that will pay within 1 year. The prepayments, these are usually expenses we've paid in advance. For example, you've paid rent in advance for the next maybe 2 years. So it will appear under your prepayments, then the cash that is at your bank. You get it? Or cash at hand. In most cases, we combine the two, which is 380,000. Non-current assets, of course, we have examples like motor vehicles, buildings, fixtures and fittings, equipment, and so on. So we also go ahead to record these values. Now, of course, these values are net of the accumulated depreciation. Basically, these are net book values. These are net book values. Okay. So we have, of course, the total assets, as you can see there. Then less liabilities. This is like the accounting equation. Assets less liabilities gives you equity. So liabilities, we can also have a breakdown in terms of current liabilities and non-current liabilities. For example, current liabilities could, for example, accounts payable or creditors. We can have accruals, and we can also have short-term loans, especially loans that are below 12 months. Then under long-term liabilities or non-current liabilities, we can have the long-term loans. We can also have things like debentures. You get it in that. And then after that, we have our share capital. Yeah. So this is just what I've been trying to explain for you. Okay. Good for you to know that under non-current assets, we can also have intangible assets. And intangible assets, this could be like trademark, goodwill is also an intangible asset. Yeah, patent rights, and so on. Anything that cannot be touched. Okay. You can also have investment property in case you have companies can also invest in other companies. So if you have an investment in another company, that can also be a non-current asset in your books of accounts, because you'll be getting dividends onto it. So that's the economic cash inflow that we expect to flow to the entity. Okay. As you can see, our non-current liabilities, debentures, mortgages, preference shares, tax liabilities, can also have provisions. If provisions are more than 12 months. Okay. And then this is just a presentation and disclosure. Okay. This is another, I think you can see our current liabilities. It's just a breakdown. And then we have non-current liabilities. Yeah, like that. So then we have equity. We have equity. Now, equity, if it's a sole proprietor, equity is just like capital. If you're running a retail shop, your equity is the capital you contributed to the business. And this could be either cash, or it can also be the value of the assets that you contributed to the business, maybe like your motor vehicle or building. Now, equity for a limited liability company can go ahead to also include things like, of course, the share capital. And this can be paid up share capital and or contributed capital. We also have retained earnings. Retained earnings, these are cumulative profits that were not distributed. So we say that a company that makes profits can make a decision between either retaining the profits or distributing them. Now, cases where it, of course, it retains them, then we have retained earnings. Some people can call it accumulated profits. Okay. And then we have reserves. And of course, reserves, this could be money set aside for specific reasons. Okay. And then minority interests of controlled entities. Now, this is so much common with group companies, with companies that in terms of that are are owned by different entities. We shall look at more of this for you to basically understand. But minority interest, these are people who are just basically, when you own maybe, let's say, less 50% of another entity, it's regarded as a minority. You have minority interest into that entity. You get it, huh? So in case we have such cases, we include them under equity. Okay. So you can see here we're trying to distribute equity. We have contributed equity, we have reserves, we have retained earnings, and then we have the breakdown. Okay. Like that. Okay. So assets and liabilities, basically here a measurement approach, just for us to look at how we measure our assets and liabilities. Now, we have what we regarding to as market value or fair value. We have what we regarding to as historical cost, original costs, in bracket less accumulated depreciation. Then we have what we regarding to as replacement cost, and then present value, which is looking at discounted values of an asset. Now, of course, we know very well that when we are valuing our assets, especially for this level financial accounting principles, we look at the historical cost, the cost at which we bought this, let's say, vehicle. We also have cases where we do revaluation. Now, revaluation comes in cases where your net book value substantially differs from the current value. I'll give you an example. If today you bought a vehicle of worth maybe 200 million, and you agree that you're going to be depreciating this asset at 10%, sorry. 10% of the 200 million means you're going to be recognizing depreciation of 20 million each. And by the fifth year, you've recognized over 100 million. And maybe by let's say, since you're recognizing 10%, maybe by the 8th month, by the eighth year, you've recognized 8 times 20 million, which is 160 million. Now, at that point in time, that vehicle will be showing 40 million onto your books of accounts because you bought it 200 million and the accumulated depreciation so far is 160 million. Now, in that case, if you think, based on the market value, if you think that value, that asset in the market is way higher than the 40 million that you're recognizing on your balance sheet or statement of financial position, then you can go ahead to do a revaluation. And this is where the market value comes in, where you look at the market value of that asset, of a similar asset in that condition. You get it? So, and then we also have the fair value. The fair value is the amount at which assets would be exchanged or a liability transferred between knowledgeable and willing parties in an arm's length transaction. Amount at which an asset would be exchanged or liability transferred between knowledgeable and willing parties at an arm's length transaction. Every time somebody says arm's length transaction, means that this is not a transaction that between a father and a son. There is no favoritism between the transaction between the buyer and the seller. You get it? So that's why it's arm's length transaction. So that fair value is considered as that, of course, as that amount. If it's assets, we are looking at a transfer between two knowledgeable and willing parties. So there is no coerce. You get it. So any value that gets out of that transaction is regarded to as fair value. And then the same thing also for liabilities, the same thing that also happens. Now, of course, like we are saying, although it is good to leave assets at historical value, it's also good for us to revalue certain assets to its respective fair value. The word fair value can also be used interchangeably for market value. So we have also limitations of the statement of financial position. Yes, we have limitations. And one of the limitations, of course, it shows the assets, liability, and equity. The amounts it shows, for example, it shows us values at a particular point in time and may not represent, of course, other points in time. For example, maybe the time after there. For example, it's a motor vehicle. It will show us the value of the motor vehicle at that point in time, but may not give us a picture of the market changes of what might happen. So it's basically the values are historical. You get it, huh? And that is why even the second point is saying that the entity's values may not be well reflected because we use things like historical values. So for example, like the vehicle, I've told you, the vehicle that you bought at 200 million after, let's say 8 years, if you've been doing right maintenance of it, that vehicle may even be still 100 million worth. But because of depreciation, you're recognizing it at 40 million in your books of accounts. So that could be, and then of course, when we are preparing these financial statements, of course, there's a lot of judgment and estimation. We saw when we are doing a provision for depreciation, different companies can have different provisions, percentages for provision for depreciation. It's very common. We also have cases where we have to, for example, we made judgments on provision for bad debts, where management just says we are reducing our bad debts to 5% and so on. So there's a lot of judgment when it comes to preparation of the statement of financial position. But nevertheless, it's an important document. And then we have the statement of P&L. So like I said earlier on, I said that we have a flow of how these statements have to be prepared. We actually basically start with the statement of P&L. And the reason why we draw up the statement of P&L, POL, is basically to determine either the company has made profit or loss. And basically here we look at revenue, or what somebody might call incomes, and then we all look at the operating expenses. So the difference between income and expenses gives us either profit or loss. You get it. Now, the component of other comprehensive income is now that goes into look at corporation tax and so on. You get it, huh? We shall see that when we come to actual examples. Okay, so here we are saying that it's beneficial that the firms consider the environmental and social performance in addition to the financial performance, which looks at people, planet, and profits. This is just one of the, this comes in after one of the limitation of the statement of P&L because it's only looks at the financial performance. So this is just a recommendation that we should also look at the people, the employees' welfare, look at the effect on the planet, making sure that we are not destroying the environment, and then profits come in later. Okay. So when you're doing the preparation of the P&L, you can either use the accrual accounting or the cash accounting system. Now, remember what we talked about the accrual concept, where we say that we record transactions as they occur and not necessarily when cash is received or paid. So that is also what happens with accrual accounting. With accrual accounting, if today you receive an invoice from your landlord of, let's say, rent of, let's say, maybe 2 million, maybe for the month of August, you go ahead to recognize that rent in your books of accounts, even when you've not paid. So that is what happens with accrual accounting. Now, with the cash accounting, it is totally different. Here we record transactions when cash is received or paid. So even when we've received an invoice from a landlord of, let's say, 2 million, it is until when we make the payment that we shall go ahead to recognize it. So in most cases, this cash accounting system is much used when it comes to these NGOs use this cash accounting system. Myself, I'm working in an NGO, so we use the cash accounting system. It's also common in government, the cash accounting system, but I think they are now moving to the accrual. Yeah, but that is what happens. But also, I think retailers, sole proprietors that don't have systems in place, for them, theirs is to record transactions when they make payments. You get it? Yeah. Okay. So under accrual accounting system, we are saying that income is recognized when it is earned. Income is recognized when it is earned and not necessarily when we have received money. And in this case, we are saying we call this accrued income. You get it? Yeah. And of course, when we receive cash, in case a customer, even with accrual accounting, in case a customer gives us money but we've not offered the service, then we have to recognize the liability as income received in advance. So somebody who is using cash system, if today you're learning, for example, you're learning financial accounting for CPA level 1, and you want to pay for level 2 in advance, maybe you have enough money, so you want to remove the burden off your shoulders, and you pay us for money for level 2, somebody who's using cash accounting will go ahead to recognize that money as revenue. Yet in reality, if somebody who is doing accrual accounting, this amount of money you've paid does not relate to this financial period. It relates to that financial period when you'll be doing the level 2 paper. And that is why if someone who's doing accrual accounting recognize that amount as income received in advance and recognize it only when we get to that financial period. Yeah. Okay. So the same thing with expenses as well. So then we have the depreciation and amortization. We already looked at depreciation when it comes to end of year adjustments, but also just to bring in the idea of amortization. If there are non-current assets, but intangible assets, we do what we call amortization. Now, examples of intangible assets, we said like goodwill, patent, or copyrights. Now, in this case, for copyrights and patents, we go ahead to amortize them. We amortize them instead. Okay? So we don't depreciate them, but the principle is the same thing. Then we also have accumulated depreciation, which we already saw, which represents the total depreciation that has been charged to the P&L in relation to the asset for the previous years. Remember, accumulated depreciation is reduced from, it reduces the assets for us to get the net book value. Okay. We have the accounting policy choices and estimates. This you can basically go through. It's just basically to give you the genesis of where does company A go ahead to say, I'm going to depreciate my assets by 10%, and company B says, I'm going to depreciate my assets by 20%. That all falls within our accounting policies, choices, estimates, and judgments. And that is why you see our companies have finance manuals. So the general accounting principles permit us to have estimates that we can make, just like the way we saw we made estimates on provision of saying a company says we estimate that 5% provision will be made at the end of the year. So we can also go ahead to make policies around our depreciation and say how much is our depreciation and also which method are we using. You get it, either straight line or reducing balance. We can also have methods of inventory costing. Here you're looking at things like maybe you're using the first in, first out model, costing model, or using the average inventory costing model, or using the last in, first out, the LIFO, and so on. So all this gap, the general accounting principles permit you to make these respective choices. And then the other is the method of valuing property, plant, and equipment. And under valuation here, I think we just saw, you can choose to say you're valuing it at market value or fair value, you're valuing it at historical cost, and so on. And then also decisions around capitalizing and expensing development expenditure also lies in the same thing. And then we have accounting estimates. Remember, those accounting choices, policy choices. We also have accounting estimates. Now, similar to the method of depreciation and accounting estimates is the useful life of a depreciable asset. For you to say that that motor vehicle, it's estimated that it will be in place for 10 years is an accounting estimate. And that gap allows you to make that estimate. The other is impairment of assets. Impairment of assets is like depreciation, but for us it's okay. It's also, you also regard it as a loss in value of the assets. So what we do with impairment is we usually test for impairment for assets routinely to make sure, like I gave you an example, if our asset is showing, let's say, maybe 100 million in our books of accounts, but in reality, because of the market changes and of demand and supply, this asset is worth maybe 10 million, then we have to, of course, provide for impairment. Things like employee benefits, like maybe retirement benefit schemes and so on, gratuity, those can also fall under our accounting estimates. Then also residual value used in depreciation calculations. Residual value is also scrap value. I think you've seen questions where they say the estimated residual value of this asset is, let's say, 2 million. Now, all those are estimates that gap allows you to do. And that's why you see things like depreciation percentage. You find company A has another depreciation percentage and company B has another depreciation percentages, because all those fall under within our accounting policies and accounting estimates, which gap allows us to make choices onto them. Okay. So we also have this element of revenue recognition. We already looked at this when we were looking at the conceptual framework, but revenue recognition is just telling us at what point in time should we recognize revenue from our customers. You get it? Revenue from our customers. Now, from the definition of revenue, we're saying that recognize anything as income, there should be an increase in future economic benefits, which can be reliably measured. Now, there are considerations that we should look at, and this is a bit at advanced level, but if you have an agreement between a customer and a supplier, I'll give you an example. If, for example, I come to your shop and buy goods worth 10 million, and I buy them, but I leave them at your premise, I've not yet taken them. The question is, do you have to first wait when you make the delivery to me, or you can actually recognize the revenue immediately I pay you? Remember, you still have this stock within your warehouse. I've not yet taken it. So it is just such circumstances that we go ahead to make certain considerations. So one of the consideration here we are looking at is, does an agreement for provision of goods and services exist between the entity and party external to the entity? Then, has cash been received, and does the entity have a claim against an external party that is for a specified consideration and is unavoidable without penalty? That is one other consideration. Either you've received the money or you have a claim against the other party. Then the other consideration to look at is, have all acts of performance necessary to establish a valid claim against the external party been completed? Now, one of the acts, like I've told you, have you made delivery? You get it. An act of performance. Have you made delivery to the other party to be able to confirm that it's a valid claim with you and the other party? And then, can you be able to reliably estimate the value that you collect in terms of debts from the customer? So once you have those considerations, of course, made, then if your answer is yes, then you should go ahead to recognize that revenue. In case that is not the story, then you should not recognize that revenue, okay? Because there's something missing. For example, if you've not delivered, or you cannot estimate the value, or no cash has been received, and there is no kind of, you don't have any kind of claim against an external party, or there is no agreement, then you wouldn't go ahead to recognize. So that's saying, to determine if income should recognize, the considerations have to be taken into consideration. So we have expenses, not different from incomes, where here we recognize, this is just a definition according to the conceptual framework. So we recognize expenses when there's a decrease in economic benefits, and then when we can reliably measure these expenses. And it's also good for us to note that expenses do not include a distribution to owners. Distribution to owners is like drawings or dividends. So dividends and drawings are not part of expenses. Yeah. So this is just trying to show us the cost of sales. You know, when you're doing up the P&L, cost of sale is important, where we look at the opening inventory, add purchases, less closing stock, and get the cost of sale expense. Okay. This is when we are drawing up the P&L. We are going to see when we try out an example. Then other expenses that we just looked at could be wages, salaries, depreciation. Cost of sales is basically, if you've sold goods worth 20 million, something is cost of sale if you're looking at how much did it cost you to produce those, to get those goods ready. The goods you've sold for 20 million, how much did it cost you to go to get those goods ready to sell them? You get it. So if it's a running business, that is why we look at what inventory have you started with. We look at what inventory have you started with, what purchases have you bought in a period, and what inventory are you remaining with. Now, what you started with, add what you purchased and less what is remaining. What is in the middle there is the inventory that has been sold. So the value of that inventory that has been sold is your cost of sales. You get it. And when you subtract your cost of sales, of course, from your sales, you're able to get your respective profit. Okay. And then expenses, we have examples here. Okay. So I don't know if we have any question, but if we don't have any question, I think since it's already time, we may stop here. We may stop here.